Hi guys, Boris Dorfman, LBC Capital Income Fund. This is a big one. I've been promising this for a while. We're going to talk about multifamily investing. Okay, my channel is for people that want to invest in real estate and are looking for yield. My channel is mostly for accredited investors, guys that do have experience in investing and have substantial amount of money. And we're talking about big investments today. We're talking about multifamily. Keep in mind that real estate investing is local. Yields and hunger for yields is local. Rules are local. California has, for example, has rent control. Other states don't. There's a lot of things in that California has that other states don't have. Okay, so let's dive into multi-family investing. I have 3 examples. Oxnard we bought for one of our clients, investors. Runnymede is the one that we actually bought ourselves with partners. And what are you looking at and what are you looking for investing in multifamily? And again, if this is your first project, you have to have a very solid real estate agent that knows these things, and you can always call me for advice and for my take on this. And what I'm going to tell you now, this is how I evaluate properties, but everybody does differently and everybody's looking for different things, right? 2 attributes why you invest in something. 1 is cash flow. 2 is appreciation. It may be a combination of both. There is also a 3rd one. It's property banking. These are for huge whales that need to stash money somewhere. But for the most part, you're investing either for cash flow or for long-term appreciation. And California is not going to give you as much cash flow as some other states, but California will give you long-term appreciation. For example, everything else being equal, some property in the middle of nowhere may give you cash flow, but 15 years from now, it's going to be worth exactly the same because rents are not going to go up as much. Okay, let's dive in. Okay, Runnymede is the property that we bought when COVID just started. It was an opportunity. It was listed at $2,650,000, which was a bit under market. This was the time when people were figuring things out and were waiting for world come crashing. So it was listed at $2,650,000. We got it a little lower than that. Okay, so we're looking at the price that we're gonna buy it at. We're looking at the rental income. This property has had income of $200,000, give or take. I think $202,000. We're looking at the yearly. This is a yearly figure. Okay. The property was 15 units. So figure, 200 divided by 12, it's about $17,000 a month by 15 units. So average rent is about $1,200, okay? So yeah, it's 15 units and the property was 10,280 square feet, okay? So the things I'm looking at is I'm looking at GRM. This is gross rent multiplier. You guys are used to cap rates. If you do your math correctly, same property, same attributes, you're gonna come to the same figures, right? But cap rate is a little bit more complicated. We're gonna talk about GRM. It's the gross rent multiplier. You take the price of the property and you divide it by total rents. Okay, this one was 13.25. Gross rent multiplier is also sometimes people talk about, I bought this property at 13x. That means 13 times gross rents. Okay, so if you take 13 times gross rents, you come out at $2,650,000. Okay, this number, the lower it is, the better it is. Okay, back in the days in 2009, everybody were looking for properties at 10x, right? So this property, $200,000 yearly income would be $2 million property at 10x. Anyways, GRM, you're looking for low GRM, okay? Also, I'm looking at price per square foot. Okay, this property is $257 price per square foot. Again, you take the price divided by square feet. You're also looking at price per door. So this particular property was $176,000. When you're looking at these things, right, your price per door, are you buying studios or are you buying 5 bedrooms? So obviously you have to compare apples to apples. Also neighborhoods. Obviously your Beverly Hills is going to be a lot more expensive per door, per square foot, and GRM is going to be a lot more higher, right? You go to Fresno, you're looking at a lot lower GRM, you're looking at a lot lower price per square foot, price per door. This property is in North Hollywood, so we call it this particular part of North Hollywood, I'd call it a C plus neighborhood. Call it a C neighborhood, okay? These are good numbers. So there's no properties on the market at this GRM, at this price per square foot, price per door. Again, this was somewhat at a time where people needed to divest. We jumped on it, but it's a good starting point. And if you guys email me, I can email you my spreadsheet and we can go over it, okay? Let's do another example. So this was roughly $3 million property. The rents were a little bit, so it was a little bit more expensive. The rents were roughly the same, a little bit lower. So obviously more expensive, less rent. You're looking at 15.6 GRM, but it was a larger building, 14 units. It had a lower price per square foot. So obviously larger units, better property, and price per door was higher. It had less units, but units were larger. Unit mix, these were larger 2 bedrooms. I think it had 2 units. There are 2 plus den. Okay, these are also very good figures, and not every building is the same. This property, it was also in North Hollywood, but it was a much better part of North Hollywood. And the property had a pool, and it was just a nicer and better looking properties. Obviously the numbers are going to be different, but this is still also very, very good numbers, and you're getting very low price per square foot. Things like when the building was built, very important. Obviously new building will have less deferred maintenance. Also new building doesn't have rent control. Okay, so new buildings will have higher GRM. They will also have lower headaches. But on the flip side, the rents are going to be higher, and maybe your vacancy rates or non-paying tenants, these guys are paying $1,200 to $1,500, $1,600, $1,700 a month. Imagine you have a new building with 3,500 square foot, 3,500 a month rent. When market slows down and when COVID happens or government talks what they do, there's going to be a lot less people willing to pay 3,500 and living there for free than guys paying lower rent, okay? And also, investing in multifamily, big boys always say you want to buy good neighborhood, but you don't want to go over the top. You know, Donald Sterling always bought buildings in the best neighborhoods, but he never made them luxurious units, okay? He made it kind of working families, middle of the road, lower rents than the neighbors, because when market cycles, market goes down, his people would be paying versus somebody paying $4,000 for 2-bedroom now. They get laid off, they're going to be looking to move for a lower price point, okay? This is something we were evaluating recently that kind of looked good. It was a bigger building, 24 units, North Hollywood, better part, kind of like Oxnard, 4.3 million, 321 rent, 329 rent, 13 times gross. 13 times gross, 13 GRM, it's an amazing figure, okay? So it's kind of comparable to Runnymede. Square footage, price per square foot was higher. This one was somewhat on a higher side, about 180. So these two were kind of comparable, and this was today, this one was COVID just started. But the biggest thing also, when you're looking at these things, you may get different figures when you get properties that are maximizing rents. This one, like I said, the rents are very low. If you take market rent, 15 units at $2,000 a month. This would be market rent. So $2,000 a month for 15 units, that's $30,000, $2,000 per unit, right? So we talk about $30,000 a month times 12, it's $360,000, okay? $360,000 a yearly rent. That's almost 1.5 times what we have now. This would be market rent. The key is this is rent controlled state, okay? So, but when you do get, maybe it's going to take 5 to 7 years, when you do get older renters at market rate rents, right? You would take this 360, multiply it by 13 GRM, and you're looking at $4.5 million property, okay? So you're looking at $2 million appreciation, okay? How long does it take? Is it easy? But it's certainly doable. We bought it a year ago. We currently have 1 vacancy, and it's on the market. It may take you, $15,000, $20,000 to rehab the unit, make it a little nicer. Again, don't go over the top and stick to the neighborhood. You don't want smart home and hardwood floors and expensive vanities in North Hollywood. At the same time, if you're buying Beverly Hills, you don't want to put cheap stuff. Stick to the neighborhood, don't go over the top. So figure 15, 20,000 remodel per unit, 15 units, 300,000, maybe some work outside. Slowly, 5 to 7 years, $4.5 million property. And again, 2,000 per unit, these are today's prices. 5 to 7 years from now, rents will be higher. Okay, how does the numbers work and how does the bank finance these things? Bank uses a ratio called DCR, debt coverage ratio, or DSCR, debt service coverage ratio. Basically, the higher the rents, the higher loan amount they're going to give you. We got $1,555,500 loan. We bought it at $255,000, so figure we put about $1 million down payment, which comes out to roughly 40%. Okay, so figure 40% down payment, 1.555. We got a 3.4% rate, and that amortized over 25 years. Rates are a little bit lower today. Our mortgage payment, wait for this, is $6,898. Okay, so we're getting $17,000 a month rent, 17.5, and we're only paying $6,900 a month in mortgage. Obviously, there's property taxes, there's insurance, there's utilities, there's property management, there's expenses. But with this down payment, the cash flow is very nice. But what is $6,900? This is a fully amortized loan in over 25 years, meaning if we pay $6,900 a month for 25 years, our balance will be zero. Okay? As of right now, our this payment has $2,500 a month principal. Okay, so $30,000 a year. On top of the cash flow, we're reducing our loan amount. At this point, we're at $1,525,000 after 1 year. We would be. Actually, with $1,015,000, a little bit more than a year. Okay, so on top of our cash flow, again, I'm going to run the numbers. If you want to talk it over, we can sit down. I want to keep it as short as possible. But we're getting cash flow. We're reducing our principal. What's going to happen in a couple of years? This number is probably going to be about $1.4 million. This $200,000 is probably going to be $240,000. So let's say we're going to have $1.4 million loan. Let's say 2 years. Our rents, we're not going to raise it. We're realistic. We're not going to raise it to $360,000, but call it $250,000. Okay. We got it at a low GRM, but let's call it 14. We're going to value the property at 14 GRM, right? And we're going to value this property at $3.5 million. we're probably going to be able to get a loan amount of roughly 2.2 million at that point. Granted, the rates are not going to increase. We're going to refinance 1.4 into 2.2. We're going to cash out 800,000. We're going to place that 800,000, maybe add another 200 and buy another property like Runnymede. Okay, 3 years it's possible, 5 years more. If you're very charismatic and you were able to churn your tenants faster, it can happen faster. So value add properties really pay. You're gonna have to put in a little bit more work, but this is how the numbers work. Okay, I have this spreadsheet. If you want to email me, let me know. Email me and I'll get you the spreadsheet. We can go over it. If you want to invest in multifamily, let me know. I can probably put you in touch with the right people. This is an alternative to investing into our fund. You're not going to get 8% yield from this, but you're going to have tax benefits. You're going to have appreciation. You're going to have to put in a little bit more work. Don't put all your eggs in one basket. Invest a little bit into our fund, buy a multifamily building, buy, do a little bit in S&P 500 and stock market, be well diversified. Meanwhile, go to work, make that money, and call me, we'll talk investments. If you haven't subscribed yet, please do so right now. Thank you, guys.